Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, December the 10th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I talked about everything from economic to geopolitical and market analysis. I'm not only here in these daily market commentaries to talk about those various things and how they implementation impact the overall markets, but also talk about options and how we can implement those into our portfolios. All right, well, without further mumbling and jumbling, please remember past performance of any trading system or methodology is not necessarily indicative of future results. And we've got some economic data to go over across the pond, mostly in Great Britain. Great Britain's GDP came in unchanged, expected to be a positive 0.1%. So a bit of a miss there, and across the board, other than the manufacturing production came in at a positive 0.2%, expected to be a positive 0.1%. But we got construction output coming in at a negative 2.3%, expected to be a negative 0.2%, so a pretty big miss there. We also got industrial production coming in lower than expected at 0.1%, expected to be a 0.2%. So just a 0.1% miss there on that economic data. And the German ZEW economic sentiment came in at 10.7, knocking it out of the park for Germany. Was not expecting that, expected to be 1.1%. And we got the economic sentiment out of the greater European region for that same ZEW coming in at 11.2, expected to be a positive 2.2. So this is a good number. It's basically investors' analysis and knocking it out of the park. So above even indicates business optimism, and below even is pessimism. Last month, remember, those numbers were pretty low, just teetering on unchanged, which is what we were kind of expecting for this month, but knocking it out of the park on those two economic data points there. And then when we move over here to the United States, we've got our economic data points. We got the NFIB, National Federation of Independent Businesses Small Index, coming in at 104.7, expected to be 103.1. And that, one of the higher readings we've seen in quite some time. Last month it was 102, but starting to creep back up. I think it was probably, in the summertime where we saw that last reading up at those levels. And then we got non-farm productivity, which came in at negative 0.2%, expected to be negative 0.1%, so pretty much in line with expectations there. We did see labor costs weighing a little bit, which we'd like to see those labor costs go up because that means wage inflation, right? So that came in at 2.5%, expected to be 3.4%, so not really great there. We got a bond auction later on today. Tomorrow, a lot of great economic data. We got the CPI, we've got crude oil inventories, we got the FOMC coming out with its results, expected to be unchanged at 1.75%. So a lot of it's going to be in their statement and what they have to say about the overall economic picture. With the unemployment number that we got just recently, I don't think that they're going to lower rates. As a matter of fact, I don't think they're going to raise rates either. I think they're going to basically talk about leaving the rates where they are for the foreseeable future until there's any kind of catalyst to really change that. I don't really see anything coming around that could really drive that in either direction, to be quite honest. All right, let's talk about the overall equities. We've got crude oil. It is staying above that $59 a barrel, which is going to act as support. We've seen it act as a resistance on the way up. Several times was tested and was never able to really get above it and sustain it. You can see we've got several points where we came up and tested it up here and then fell off and away from that, where the point of control is right here at $56.50. Now we're above that $59 a barrel, which lines up with this Fibonacci here and the 38.2. So that is going to act as support. Basically, we could call it staying above there yesterday. But remember, we get up into those 60s and we would really start to see some slowing of momentum to the bullish side. I don't expect it to go much above 60. It may kind of hang around there, but I think the mid to lower 60s is kind of out of the picture at this point with the way that the economic picture is looking as well. So we're going to just have to wait and see. It is in a nice trending kind of channel here. If we can pull this up, basically driving that way. So that is a bullish trend channel, and one could say that it is looking to go to that $63 a barrel there. So that could be a target. I'm going to stay away from crude oil. My feelings on crude oil is we would really like to see that market come back off, therefore allowing us to spend money elsewhere. It's more of a tax cut than anything when you get those lower gas prices, because you're allowed to spend that money that you would put in the tank somewhere else. All right. Then we've got gold futures moving a little bit higher. Now, today's kind of a weird day. We've got a lot of different types of news streams coming out. We've got the impeachment hearings. We've got sorry about that. Let's close out Adobe. We've got the impeachment hearings. They're basically moving forward with that. But we also, on the flip side of that, wanting to drive the markets higher is the tariffs in China. We have a delegation going to China to talk to them. They're basically saying they want to buy some pork. I guess their people are tired of starving over there, and they want pork from the United States, which is part of that mandate on the tariffs. So that might push the tariffs back at least past Christmas season. So we're going to have to keep our eyes out for that. I've talked about these tariffs coming due this weekend on Sunday, so that could really impact the overall market. So we're getting a push higher when that information came out. Markets started making their highs, but then immediately on the flip side of that coin, we heard that they were going to move forward with the impeachment hearings, which isn't a surprise, to be quite honest, with the way that the Democrats have been talking. So that's caused some weakness in the market. Gold doesn't know where to go, but all signs point to upward if there is volatility in the market. All right, bonds unchanged ahead of the FOMC. Really, this morning on some of that news of China, we were seeing the lows or the high yields in bonds. Remember, it's the teeter-totter effect. As bonds go down, then the interest rate goes up. So we can kind of draw it like this. If you think of this as the interest rate and the bond prices, it's a teeter-totter. So as prices go down, as price goes down that way, then the interest rate goes up. So we used to say it was like a little bit of a teeter-totter effect. They move back and forth that way. So right now, kind of coming back to close to unchanged, or we're at unchanged right now. All right, VIX is in negative territory. We are back into the teens after yesterday's big move higher. That helping us with our option pricing, right? A lot of things are not seeing very high implied volatility percent because we're kind of outside of earnings, and that has caused the VIX and everything else to come really off. There's not a whole lot of unknowns other than the China tariffs and this impeachment hearings. So that is kind of driving volatility a little bit higher. Here we have the Dow Jones Industrial Average up 10 points on the day and near the highs, it looks like right now. If we go over to the NASDAQ, up 30 points and, just slightly off the highs. One thing to note about all of these markets, though, yesterday we did look like we were settling below that 9-day moving average. In the blue is the 9-day. We've got the 9-day simple moving average in this blue area. Now we're back above that. So we've been trending below, which is a sign of short-term bearishness. Now we're back above that. If the market can stay above that, it's going to be back off to the idea that we are going to be looking at the trend channel continuing to move higher that way. So the market's still relatively bullish. A lot of people worried about the these funds, hedge funds, and money managers covering a lot of this, because you can see since the beginning of the year, we started out well down in this area, and that is a lot of upside to the markets. Now, people are dying to cover at that point in time, because they can come out and put out different marketing type things saying how well they've done this past year, trying to get more money invested with them. So we could easily see the market start to trend higher, and or not really trend higher. We could really see the markets correct a little bit here in December before we start seeing them trend higher in January, because they want to lock in profits ahead of the new year. All right. So again, E-mini S&Ps, I've talked about this. Market is still continuing to trend. We are above the 9-day moving average. Again, remember, this is the 9-day again. We are trending as well where the market wants to move in. That's a really wide trend channel, but I would say that we're kind of looking at this being the target. Whoops, I want to pin there. This being our target up there in and around 2186. That lines up with my 78 Fibonacci extension, which I've kind of drawn based on the market moves that we've seen recently. So that gives me a little bit of upside idea as to where we might be going. So I think that first quarter of 2020, we should easily see that 3286, aside from anything crazy happening in the United States and or recessionary aspects. All right, here we go. This is basically the news of China driving us higher. We got right before the market opened, or right after the market opened, the Democrats saying that they were going to move forward with impeachment hearing, and you can see we got a bit of a sell-off there, down close to the lows of the actually those are the lows of the day session, but close to the lows of the overnight. Now we're starting to see that market recover, and in this candle have seen the highs being printed, trying to move into yesterday's range, which was pretty much an inside day. All right, so enough about those markets. Let's talk about my markets. We are going to talk about Netflix. All right, Netflix was just downgraded. They are one of the higher subscription rates for the streaming, and yes, they do have a lot of movies and stuff like that, but not everybody, like myself, don't really watch a lot of blockbuster movies. I like to watch more of the History Channel and stuff like that. Therefore, it doesn't really make sense for me to have Netflix when there's Hulu and Sling out there, where it has lower price points. I can actually pick some of my specific TV channels for a much lower price point. Now, if Netflix doesn't do that, they could start losing subscribership. All right, and that is why they got downgraded. So I'm building a case here for Netflix on shorting it. Now, what is the best type of strategy to short Netflix at this point? We got a bit of a mid-range and implied volatility. The market has moved back below this 50 Fibonacci here, and we got a nice volume node down here at the bottom, where I think that the market might look to revisit relatively soon. All right, and that being said, what is the best strategy for that? Well, synthetic short. I don't have to go out there and borrow this stock. I can build that same type of strategy with the same risk reward as I would by shorting the stock. Okay, so I'm going to show you how to build that out properly in that webinar on Thursday. I don't know if I'm going to be able to wait till Thursday to short this stock, but I'm going to try. Maybe you get a bit of a bounce here in Netflix over the next day or so. That'll allow me to set this up for that webinar specifically. And so keep your eye out for that. Go to Pro Trader Strategies and sign up for that, because that's going to be a really good one. And then we move over to Apache. Now, if you guys remember Apache, I got into this trade on the 27th, which was right here on this little bit of a green volume node, and I played it to the upside by selling some puts. We had high implied volatility percent. As you can see here, that implied volatility percent was, we had an IV percent of 100. Okay, so 100 IV percent is about as high as it can go. Yes, it can uptick a little bit more, but right here is where I got into that. And I went in and I sold the December, which is the December 19 puts. And I was able to do that for a collection of, what was it, 52 cents. So I collected 52 cents for that trade. Now, we got this move well against me. You can see my 19 puts were easily tested, which is basically lining up with that volume node here. Broke below this low, which is where I was expecting to get out if it broke below that, but it snapped down so much and we got this volatility crush coming off. So that volatility crush coming out of the market, despite the fact that this trade went in my face, right? My puts were in the money. That volatility crush allowed me to stay into this trade a little bit longer. I was down a little bit, but not as much as you would expect on a $4 or $5 move to the downside, more of a 20% correction almost in that market to the downside. Well, it stayed pretty much unchanged. Now I got that bounce back up, back into the value area. So we got the value area low right there, and we basically got back up into that value area low. The volatility continues to come out, and I was able to get out of this trade for a profit. So I covered this trade today for what was it, 14 cents. So nice winner there, winner chicken dinner on the cover, and that's because we set these strategies up with the highest probabilities of success. Yes, I was directionally wrong. I'm still directionally wrong on this trade from when I put that on at inception right there on the 27th. The directionality moving against me, but volatility. And because I set the strategy up in the right environment, allowed me to get out of this trade for a nice profit here in Apache. Okay, so that's all I got for you guys today. I hope you guys follow in these webinars. And other than that, if you can't take that, take it easy.